Hi everyone, thank you all very much for joining. So today's session will be with myself and my colleague Tala, and we'll be talking about the actuary's role in reinsurance. So as a bit of an introduction, we'll give a brief background to myself and Tala, and then I will then go through a number of different sections on the reinsurance basics, forms and types of reinsurance, my day as a pricing actuary, the kind of things that I get up to, and then we'll switch into Tala what he gets up to, and then he'll also look at, as a last section, kind of the wider actuary roles in reinsurance. So there will be time at the end for question and answers. So if you do have a question, please drop it into the chat, and there will be time at the end to answer any questions that you may have throughout the presentation. So moving on, I'm just going to give a brief introduction to myself, and then I'll hand over to Tala briefly to introduce himself as well. So as Marwa mentioned, my name is Christopher Jones, or Chris for short. I'm a pricing actuary at Munich Re. So my background is I studied in the UK at Swansea University. I did maths for finance and graduated back in 2011. Since then, I've actually worked in actuarial in a number of different areas and companies. So in my early days, I was doing financial reporting with FriendsLife, now what is Aviva. And then I moved to Old Mutual, where then I moved into a pricing role, specifically looking at international pricing across many different markets, such as Hong Kong, Singapore, Middle East, and UK offshore. Since 2016, I've been with Munich Re. So for the first 3.5 years of my tenure with Munich Re, I've been based in the London office, working in the central pricing team across protection business, life business, health business, financial reinsurance, and a bit of longevity business. For the last 1.5 years, I've been working with the Munich Re Dubai office, specifically in the life pricing team on takaful and re-takaful solutions across the Middle East and North Africa. And lastly, I qualified as a fellow of the Institute and Faculty of Actuaries back in 2018. Tala, do you want to give a bit of a brief background to yourself?
Sure. Thank you, Chris. Hello, everyone, and thank you for joining us today. My name is Talha, and I'm responsible for business development and client relations at Munich Re. I'm based out of Munich Re's Dubai office. In fact, both Chris and we are both based out of Munich Re's Dubai office. I'm basically a fellow of the Society of Actuaries. I qualified as an actuary in 2016. I also happen to be a qualified chartered accountant. I basically have both accounting and an actuarial background. I have worked in different insurance companies and reinsurance companies. I have experience of working in takaful companies as well as conventional insurance companies. I've also worked in different actuarial and traditional actuarial and non-traditional actuarial roles. Predominantly in my previous roles, I was responsible for product development, pricing, and some of my non-traditional actuarial roles include working on insurance systems, and in my current role working as business development, working as being responsible for business development and client relations. So in later slides, I'm going to take you through what my day looks like, and back to Chris now.
Thank you, Tala. So we're now going to move into reinsurance basics. So put together this section because naturally some of you may not have come across reinsurance in your day-to-day roles. So I've kind of structured this into kind of 4 different sections: the what, the who, the why, and the how. So the first is I'm going to talk about what is reinsurance. So in very short, simple terms, reinsurance is insurance that an insurance company typically purchases to protect them from a major claims event. So in life insurance, an insurer may purchase reinsurance to protect themselves from lots of death claims occurring, or similarly, a general insurer may purchase reinsurance to protect them against, car insurance claims or health insurance claims, etc. So with reinsurance, the insurer will pass on maybe some or all of its liabilities to the other company. company. And these companies will be the claims that they have to pay. Again, we'll go into this in more depth later. You know, some companies will have an appetite to share all of their risk, whilst others may only want to share a little bit of their risk themselves. So in terms of terminology that you may or may not have come across as well in the reinsurance space is, so typically when we say an insurer wishes to place some of its business with a reinsurer, we call them the cedant, and they cede the business to the reinsurer. Lastly, a definition that, or a term that you may have come across as well is it can be considered the insurance of insurers. So that is in a nutshell what reinsurance is. So now we move on to kind of who is involved. So who are the participants involved in this sort of reinsurance business? So the main ones, as I've said, are insurers. So in terms of others in the market, we also have banks. So banks may also partner with insurers as well, which is quite common in the life insurance market. You know, whilst we may work with a life insurer, we'll also be working with banks through their bank assurance channel as well, where they sell life products. Other typical institutions as well can include government agencies and also as well indirectly through brokers, because brokers may be that go-between between either an insurer or a bank as well. And naturally, the who is also the reinsurer as well, but I haven't put that on the slide. So finally, why do insurers typically take out reinsurance? So there's a number of key reasons why they do that. So the first three I'm just going to discuss bunched together are all risk related. So these are to limit their risk exposure. They kind of have a, you know, maybe a risk appetite that they don't want to have so many claims on their book. You know, they want to avoid the large single losses. You know, for example, if they're insuring, say, a high net worth individual, or they've got some really volatile business, that means, you know, in any 1 year, you know, the profits essentially that they have may be subject to lots of volatility. So they kind of want to smooth their results over time. So other key reasons that why insurers take out reinsurance is the availability of expertise. So for example, in the Munich Re that we have, you know, we help clients with, you know, new risks, unusual risks, new territories if they want to launch a new product, you know, and reinsurers will have experience typically in areas not just pricing, but product design, claims management, underwriting and risk acceptance, IT specifications. So these are a number of different areas that reinsurers will also support insurers when they kind of tailor in reinsurance solutions for them. The other one is opportunity to write more business. So regulations and markets may stipulate a certain amount of capital has to be held to write certain insurance products that are capital intensive. So by having reinsurance, you know, if you're able to share in some of this risk, you're also able to share some of the capital requirements of the reinsurer, lowering that and an opportunity to write more business. So the next one is financial assistance. So again, as alluded to before, some products can be very capital intensive and they can cause what's called new business strain. So this typically means on day one that the insurer will make a loss because they have to cover commissions, the expenses in setting up the policy, any marketing, other expenses, you know, setting up any reserving requirements, etc. So financial assistance can be for reinsurance, you know, either supporting the new business strain in alleviating that or providing some money to the insurer. There's also other ways you can do that. Financial assistance can be mergers and acquisitions and also improving the free asset ratio. So the above are the main reasons why insurers take out reinsurance. The other reasons may have it could be cheap, so it could actually be cheaper to have a reinsurer do all this for you. The other reasons are credit ratings, so it can look very good for a lot of insurers to have, you know, be backed essentially by a strong AAA, AA rated reinsurer. And 3, in some markets, is actually a prerequisite to have reinsurance in place. So moving on now to just finally the how. So in short, it's through a contract. So this is typically through a reinsurance treaty, and this will cover all the mechanics, and it will be a long legal document that covers right from the beginning the scope, it covers a lot of different information, which I've just briefly described here. So dates of commencement, how it will terminate if appropriate, territories of the sales, maximum minimum ages, the total maximum capacity. The key one that I've underlined here from a pricing point of view is in the appendix. There will be the schedules of the reinsurance premium rates, specifying, for example, age, gender, what product they're applicable for, what underwriting these rates are applicable for. So this is only a very snapshot of what a reinsurance treaty will have. It will have a lot of information typically to do with underwriting, authority, documentation. Claims is also a large area as well. It will also, as I said, have a lot of information on the legal wording as well that goes into documentation. So one last point that I just want to say is actually there's no contractual relationship between a policyholder and a reinsurer. So for example, if I take out a policy tomorrow with insurer A and they are reinsured through reinsurer A, I won't deal with reinsurer A. My policy will just be with insurer A, and naturally whatever arrangement they have reinsurance wise, they will deal with reinsurer A themselves. So yeah, you won't typically see any sort of, you won't have to deal with reinsurers yourself when you purchase some life insurance policy, for example, or any general insurance policy, etc. So that's a brief background to the reinsurance basics. So now I'm going to move into some of the more basic, again, forms and types of reinsurance in this section. So one thing I'm going to stress right now is this is only a short presentation today. Naturally, we don't have time to go into every single form and type of reinsurance, just because it would typically take a lot longer and we'd probably have to have several sessions on this. But what I will say is when we work with insurers, there are many different variation and contracts, and they're always typically suited or tailored to meet, the client's needs. Clients' needs can vary between big, small, they can have very different arrangements, just depending on the risk that they're taking on. So in life insurance, they're typically what's reinsured on what's known as on a treaty basis rather than a facultative basis. So this isn't always the case, but in short, what I'm getting into here is on a treaty basis. As I mentioned in the last slide, there will be a standardized treaty, and if a policy falls within certain limits, it will automatically be reinsured with the reinsurer. So facultative business is slightly different. So facultative may typically be used with say, for example, very high net worth cases or unusual risks or unusual territories, for example, or they may just be one-off risks. So those typically may be reinsured on a separate basis. For example, they may go between a number of different reinsurers shared, and typically they may have different pricing and contractual requirements. So these may typically be outside of a reinsurance treaty scope, and they'll be dealt with separately. But generally in life insurance, because there's many policies being written at a time, it's more administrative and easier to have it on a treaty basis. So again, now for long-term products, the treaties tend to be of a proportional nature. So I'm going to go into this in a lot more detail now, but for now, all I'm going to say is that there's kind of two main concepts that I'll discuss shortly: on a surplus basis and a quota share basis. So for short-term products, what I'm typically saying here, this is generally just a brief background, as this is not my subject matter of expertise, but they can be reinsured in similar ways, such as proportional reinsurance as quota share, but they also may be reinsured, for example, on a non-proportional basis. So you may have come across these terms excess of loss or catastrophe excess of loss. So yeah, again, this just shows the kind of bit more variety that general insurance may have. That's not to say life insurance doesn't have. Again, I'm just talking more generally throughout this presentation, because as I said earlier, there are many different variations and the contracts are often tailored specifically. So as I mentioned earlier, the focus on this section is going to be life insurance, specifically on long-term contracts and proportional reinsurance, which I'll now go into in more detail. So hopefully now you can see on my screen the kind of diagram where proportional splits into quota share and surplus. So when I'm talking proportional reinsurance, what I mean is the reinsurer covers an agreed proportion of each risk. So i.e. every single risk between the insurer and reinsurer, it'll be covered to an agreed proportion. So then this splits into two separate sections essentially. The quota share element, where the proportion is constant for all risks, or it may relate to what's known as an insurer's kind of preferred monetary retention, i.e. the surplus element. So these are the two main areas. Both forms have to be administered automatically and therefore require a treaty. So that's why I was referring to earlier that a lot of life insurance business will be written on a treaty basis. So these are the two main areas. Again, there's a lot of different things that I won't describe, but I'll give a brief background as I go through some of these and how they work. So the first one I want to talk about is quota share. So in this one, risk premiums and all the claims are shared between the cedant, i.e. the insurer, and the reinsurer in a fixed share. So for example, a 60% quota share means that 60% of the risk has been ceded and 40% is retained. So as an example, you have insurer A has a 75% quota share arrangement with Munich Re. So in this one, again, life insurance example, say we have a policy with 100,000 euros of sum assured cover. So in this instance, insurer A's share of the risk will be 25%. So sorry, that's an error on my side. That should be 25K. And Munich Re's share of the risk will be 75% because the insurer is ceding 75% of the risk to Munich Re. So this is quite a very simple and straightforward relationship here on quota share. The next one that I'm going to talk about briefly is surplus. So again, this depends really on the surplus amount. So specifically, reinsurers will only participate above a specified retention amount. So in this instance, let's say insurer B retains up to 100,000 euros on this, and then Munich Re has a 50% share above this. So this is a bit different this time. So on the quota share, as I said, it'll be each and every risk. But here, for example, let's take the example again of the quota share where we have 100,000 euros. So in this example, insurer A's share of the risk is 0 because insurer B retains up to 100K. So then Munich Re's share of the risk is only 50K as we only take on 50% after that. The second example, which I've just pulled up on screen as well at the same time, is 500,000 euros. So in this instance, insurer B's share of the risk is 100K. But this time, Munich Re's share of the risk, we only take 50% of the excess amount. So we do 500K less the 100K that is retained times 50%, which gives us the 200,000. So this is the big difference here between quota share and surplus. So on a surplus, a reinsurer may not see a large amount of risk just purely because it depends on the retention level set. If an insurer sets a very high retention level, the reinsurer may only see very large claims, whereas on a quota share, the reinsurer will see each and every single share. So there's different reasons why, again, reinsurers and insurers will have this arrangement. So a quota share allows sort of a spreading of the risk, and kind of it ensures that the reinsurer is taking a capacity of each and every risk. So this is very good for the insurer. But surplus is also good for, say, for example, an insurer only wants kind of really, like I said, reinsure those peak risks or really high risks. So by having a surplus arrangement, it can kind of retain all the business that it wants and only cede those risks. So again, this again comes back to different styles. So again, these are just two different elements. Some insurers actually want a combination of these as well, which is possible. So again, these are just the very basic outlines here of quota share and surplus risk. So, like I said, there are many different types and forms of reinsurance, which we don't have time to go to today. So some of them which I naturally haven't captured, you may have heard of, are financial reinsurance, which I mentioned briefly earlier. There may also be, situations of how we share the premium, whether we take, how we charge the premium. But we're not going to go into that today, although I'll give a bit more examples of specifically how these may relate as my day as a pricing actuary now, which I'll go over. So as I discussed at the beginning of the presentation, I work in the life team in Dubai, and we're responsible for the Middle East and North Africa MENA markets. So these cover all of the GCC, so Bahrain, Kuwait, Qatar, Oman, Saudi Arabia, and the UAE, and also the Levant markets of Egypt, Jordan, and Lebanon. We do cover some other regions, but typically these are the main markets that we have a lot of business with and have a lot of expertise in. So what do I do as a pricing actuary? So my main primary task is essentially to work out the price that we as a reinsurer should charge by essentially calculating the risk. So essentially a lot of the time I'll be analyzing data and figuring out, okay, this insurer wants to launch this product. How are we going to do it? How do we, set our assumptions accordingly? Because a lot of the time in life insurance, we're dealing with death or disability. So a lot of the time, like I said, it's determining the price and figuring out how the insurer wants to work with us, and essentially determining a price for the risk that Munich Re, for example, would be taking on. So the key thing here that is the very difficult part is we always, we need data, and we also want to develop profitable yet competitive product pricing for our clients. So there's always a conflict here. The client naturally always wants the cheapest premium rates, which can be obviously very difficult because we want to determine a profitable product. So sometimes, it's very hard to get a very profitable and a very competitive product because typically one has to give. So it's always a challenging exercise, this. I would say typically in this role, there's a lot of different thinking and lots of different hats that I typically put on. So it's kind of balanced against internal needs. And again, one of the key things is kind of strong risk management, which I'll discuss in a few examples. So first case study here. So client in UAE wants to launch a new term assurance product. So for those that aren't familiar, so a term assurance product pays out a sum assured, say, of 100,000 euros if a person were to die during the term of the policy. So this client wants to launch a new product that competes with their key competitors. They want medical underwriting on the product, but they want it to be simplified. They don't want a long application form, because advisors want to kind of get policyholders onto the books quickly. So they've come for us. They will basically want a sample of our reinsurance rates to basically determine whether, they're competitive enough that, they can move forward with this product proposition. So this is a typical situation. So again, my task can include generating the reinsurance rates. That'll typically be obviously the key part of my role. I mean, this is actually, there's a lot of multiple things to think about here. So one of the things is, again, we need to set the assumptions. So again, we need to really understand the client, who are they selling to? What distribution channel are they selling? Are they selling direct to a consumer? Are they selling via the internet? Do they have advisors? Are they tied agents, etc.? Because all these items can influence the assumptions that we set. So one of the things then, once we kind of have a really good understanding, this will typically be back and forth with my colleague Tala to understand what the client's needs are. And then we carry out the pricing with our kind of Munich Re global actuarial standards, which kind of include, global pricing treatment of certain cash flows, such as claims, expenses, taxation, etc., depending on the jurisdiction. So after we've done the pricing, we'll come up with rates, but naturally we need to have a good understanding of, in this situation, the underwriting. So, we need to discuss with them, okay, so they want a simplified underwriting product. So what risk does that introduce? For example, are we going to potentially have people non-disclosing where, for example, if we remove a certain question, will that mean, that the risk is more, for us to be taken on, and should we charge for that? Or, for example, how could we combat that with a different way, maybe an exclusion in the policy terms and conditions? So this will be back and forth with both underwriting and the claims teams. As I mentioned earlier, this isn't, a one-off, email that will happen with Tala. It will probably be multiple emails back and forth, multiple calls back and forth to kind of, fully understand what the client is asking, because through some of these, the client has to really think as well, okay, does that work? Does that make sense? Okay, if the competitor's doing that, do we want to do that as well? So the key thing as well is here, so we won't just kind of produce the rates in isolation. We need to kind of really do a competitor analysis as well, we need to know what they're offering. Is the product that our client wants to offer the same? Is it different? If it's different, how will that impact the price up or down? And our basis is we want to ensure it's on a like-for-like basis, as close as possible. As a very, crude example, we don't want to be comparing apples with bananas or pears, etc. So the final few things is kind of getting sign-off from our head of pricing. So we'll have to have a discussion about that to ensure peer review is done. And the final thing is kind of checking a risk referral process. Does this need to go for regional approval? Do we have the local authority in our team? So these are just kind of some of the tasks that we'll do. Again, there may be other tasks that we have, but these would generally be the key tasks. And once we've kind of gone with that, we'll discuss with Tala and he will then discuss with the client. And then depending on that, we will either move forward or there may be a rethink of the product entirely. It can really vary client to client. So another case study that can happen is client in Saudi Arabia wants to review the premiums that we're charging. So for example, they've had really good claims experience. So they want a 10% discount. Otherwise they'll seek rates from other competitors. So again, this can happen, a treaty has been going on an ongoing basis. We've had few claims one year, 10% has come up because they've done some crude maths. So again, what we want to kind of really understand here from my perspective is how has the claim experience been? So we typically like to do an experience study. So what this means is basically analysing the claims experience. So, how good has the claims experience been? Is it just one or two claims better? Have we had no claims? Is it across all their products? Credibility is a key thing. So when I talk about credibility, it's essentially the number of claims. So if this is a very big client with a very large number of claims, typically on their book and large volume of business, the more credible it is, the more confident we can be in kind of give them a discount. If it's just 1 year where they only maybe have 1 or 2 claims a year, it's a very different story. So after we've kind of gone through that, and maybe we won't carry out an experience study, we will profit test the business. So this essentially means assessing the profitability of the premiums that we're currently charging against our best estimate basis. So similarly, on step 1, we would set all the assumptions for expenses, our profit, the the claims assumptions, the economic and etc. assumptions for that. And we would basically understand the profitability of this business. So once we have a view of that, we will take a decision. So in terms of other considerations, like I said, these are just some of the main things that I'm pointing out. I'm not going to go through all of these, but how big is the business? Do we have other business with them? They're asking for a discount on reinsurance rates, but could we do other things? For example, could we review the benefit design? Could we offer them an optional guarantee that would make them stand out from other competitors? So there's a few different things that we can do here. And lastly, in terms of another case study, recent information and other business unit information is going that mortality improvements are lower than we have set in our basis. So some of you may be aware from global trends, mortality improvements. So that's where we're essentially talking about the change in mortality rate from year to year. And mortality has been historically in the past improving. Again, this is an entire topic in itself, one that I'm actually very interested in. But essentially the reason for mortality improvements over the past couple of decades have been, people reducing smoking, people taking greater exercise, medical advancements, etc. So in certain markets, we are still seeing high mortality improvements coming through. So for this, the first thing we really want to understand is whether this is true, because different ages, different genders, different regions will all have different impacts. Some older ages may be impacted more because there was a health change that was impacting them to a greater extent, or vice versa. There may be certain ages which have been more penalized because certain items have been moved away. So it's a very tricky task. Typically what we would do is we would get data if possible, population data or industry data, or both those two aren't available. We kind of use overseas data. And depending on the availability of these, we perform a mortality improvement analysis looking at all these different items. So just in terms of other considerations that we kind of do here, is this what we call a blip, or is it an expected long-term trend? Just because you've had, one really good year of mortality improvements, is that the case for the future? As I mentioned earlier, does it impact all assumptions equally? How material? So these are kind of all the things that I would kind of be considering here as well. Should we consider updating the basis as well? So that's it from me on my kind of case studies. I'm now just going to hand over to Tala, who's going to talk specifically on the business development and client management role.
Thank you, Chris, and hello again, everyone. So basically, my role in Munich Re, as I shared with you in the beginning, is basically being responsible for business development and client relations. So this is not a traditional actuarial role. This is not something that we, when we are in the university or when we are going through the exams and going through the books. So this is not something that we really come across. So this is basically a non-traditional actuarial role in the reinsurance space. So I'll be sharing what my day looks like, what I do, and what are the skills basically you need to have in order to be successful in this role. So Chris, if we could go to the next slide. So basically, what is business development and client relations? So these are basically two things that I'm responsible for. So business development is basically marketing your company's own products, services, solutions to external parties, and then entering into contractual relationships with them. So this is basically what business development is. And then client relations is basically once you have this relationship with them, once you have an agreement with them in place, then to go about day-to-day business, go about solving day-to-day problems, keeping those relationships going. So that is the second part of my job, which is client relations. So that's how business development and client relations come together. What I've done in this slide that you see on your screen now is basically a list of some of my responsibilities, and I'm going to go through them one by one and try to explain to you what I do in this role, and being an actuary, how does that help in fulfilling the requirements of this role. So basically, the first and foremost very important part of my job is to understand the market landscape. Now, this is a very broad term, and I'll explain you what a market landscape means. But before that, we need to understand what a market is. So basically, in reinsurance world, when I have to go out and get business for the company, firstly, we have to define our markets. Market could be a country, market could be a continent, market could be a geographic area. For example, Middle East could be a market, North Africa could be a market, Africa could be a market. Market could be a province, a state within a country. A market could even be a city. So it depends how you are defining your markets. So for simplicity, let's say I'm defining my market as a country, and my market is, let's say, Egypt. So when we have decided that, okay, Egypt is going to be one of my markets, I'm going to define the market landscape. I have to understand and write down the market landscape. What is a landscape? So a landscape would be to know everything about insurance in that market. The landscape would need the size of the market. So how do you get that? You need to know all the insurance companies that are there in the market and how much business they are writing. Then you need to understand what sort of insurance business they are writing. Are they writing life insurance business, health insurance business, medical insurance, or any other type of insurance? Then you need to understand how that market has been growing over the years. Is it growing? Is it going down? Is it expected to go up in the future? What is going to happen in the market? Who is the regulator in the market? What regulations are in place? Are there any new regulations that can happen, that can come in near future? So for example, in your case, I will have to see what is the role of FRA in the market, Financial Regulatory Authority, FRA. What is their role? How much influence do they have over the industry? What are their laws, policies, regulations, and what are the expected laws going forward? So this all basically constitutes the market landscape. I have to understand this very well. So even though I have to be based out of Dubai, but I have to make sure that I have an understanding of the market landscape. Another very important point that I need to understand is what is the behavior of the customers in that market? Are they looking at life insurance? Are they looking at medical insurance? So what are they actually looking at? What are going to be the trends going forward? So this all basically constitutes the market landscape, understanding what the market is. So this is my first job. When I have understood the market, I am going to come back to my office, and now I am going to make a strategy to increase my business in this market, let's say in the Egyptian market. I am going to put the market landscape on one side, and then I am going to put my products, my services, my solutions, my strengths on the second side. And then I'm going to see what are the things that I can take from here and go and sell in the Egyptian market. What are the things that fit well? What are the things that are working well in the market? And is it going to continue? Or are there some things in the market that are not working well and the market needs a change? Can I give you a change? For example, there could be a lot of companies in the market right now. When I went and I spoke to them, they told me that they are looking for digitalization. They are looking to automate all their processes. So maybe I have a software in my company which can help to automate and digitalize their insurance processes. So I'm going to make that as part of my strategy to give this to my Egyptian clients. So this is how I make a strategy for the market. And when I have the strategy in place, I basically put out a plan how I'm going to go and execute this strategy in the market. So that could be going to a company ABC in the month of February giving this solution, following up in March, getting more leads in April, and so on and so on and so on. So I have a full year plan how I am going to give these products, services, solutions, softwares in the Egyptian market. Another point to note in this strategy is, now there could be different types of strategy. A strategy could be that I'm going to increase companies' business and get new business from Egypt. Or it could be that I look at another market and I see that in this market, I cannot give anything new at the moment. Many reasons why I cannot give. Maybe my products are not required there. Maybe there are some regulatory changes that I am expecting. So I will wait for those to happen. So my strategy could be, don't do anything for now, just maintain your existing business. And that's also okay. So it could be different strategy. My strategy could be that I look at a new market. I look at a new country. So all of these could be my strategy. So first, market landscape. Second, strategy and execution of the plan. Point number 3. Now, when I'm executing a plan, I am going into the market. I am talking to different people. I'm talking to CEOs of the company. I am talking to reinsurance managers of the company. I am talking to the actuaries in the company, some of you guys. And then when they are requesting me for a quote to transfer their risk, I bring that information in. I give this information to Chris and my other colleagues, and we all sit together and we come up with a quote for the client, a solution for the client. I take this solution back to the client, I present this solution to them, and then when they give me their agreement, there is a lot of negotiation, a lot of to and fro. And once they give me their go ahead, we go ahead, sign an agreement, and start the business relationship together. Now, in addition to this, when we do all of these things, a very important part of the client manager in a reinsurance world is to have very good relations with external stakeholders and internal stakeholders. At one end, you have your external stakeholders, the other end, internal stakeholders. There is no connection in them. You are in between them. So you are a bridge between the external and the internal stakeholders. So your job is very important to have excellent relations with all of these people, because if all of these work together, only then are you going to have a successful strategy and your plan. Now, who are some of my external stakeholders? My external stakeholders are insurance companies, my clients. These would be CEOs of the company, CFOs of the company, chief technology officers in the companies, the actuaries, the reinsurance managers, the underwriters, and people looking after claims. So these would be my counterparts in an insurance company. And I need to have very good relationships with all of these people. Secondly, I need to also have very good relationships with the regulator. So the regulator is basically responsible for making policies, laws, regulations for your market. So I have to give my feedback to the regulator, what I am seeing in the market. If the regulator has feedback from everyone, only then can they come up with the right sort of policies for the market. So it's very important for the reinsurance client managers to also be in constant touch with the regulators. And then we come to the external consultants. So these could be your actuarial consultants. We also need to hear from them to understand how they are looking at the market. What changes are they seeing in the market? Because when they give me this feedback, I can go back and put it in my strategy. Because these guys are also working very closely with the insurance companies. And then a very important part of my relationship is to speak to the distributors. Who are these? These are your agents, your brokers. And why I need to talk to them? It's because they are the ones who are actually selling the products to the direct consumers, the customers. So they understand what the customer wants, what the customer want and they don't have now. So if I get this feedback from them, I can go back, sit with Chris, and we can make a product which the distributors can actually directly sell. So that is why it is very important to know what the distributors want, and that is why they are a very important external stakeholder for us. Now moving on from the external stakeholders to the internal stakeholders. So who would be my internal stakeholders? My most important internal stakeholders is the pricing team, which is Chris. So I would be talking to Chris multiple times on a daily basis, from one quote to the next quote to the next quote. And Chris basically makes sure that the product is technically correct and the pricing is done with the information available to him. What I do is I bring in the market feedback. What are the distributors saying? What are the trends that we are seeing in the market? Because if I give this feedback to Chris, his solution will become more and more in line with what the market needs and wants, while being technically sound. So my role becomes very important here, because if I don't give him the relevant market information, together we will not be able to come up with a competitive product. Besides pricing, internal stakeholders include underwriting and claims department. Very important to be talking directly to them, because you need to understand what are the things happening at the underwriting stage. What are the problems happening there? Where are you seeing most of your claims? And then you need to address those problems. If you are constantly seeing claims of a certain type happening, you need to go back, talk to the clients, tell them about this, and make sure that you are working with them to solve this problem. Other stakeholders include treaty specialists. Treaty is an agreement which a reinsurance company has with an insurance company. So then it's important to work with the treaty specialists to make sure that the treaties are being signed in time, the agreements are being put in place. Accounts department, to make sure that the accounts are being submitted on time by the clients, by the insurance companies, they are booked on time, payment is received by the company in the time when it is due. Others include risk management, auditors, and compliance. So you see that client manager basically is like a bridge between the reinsurance company and the insurance company. So the main job is basically to make sure that the coordination is going on between all these internal and external departments. Let's now go to the next slide, and I'll share some very interesting things with you. So these are basically some of the skills that I believe if you have most of them and you work on the rest of them, you will be very successful in the client management world. So let's start from the top, and the most important skill is the communication skills. Now, communication is any information that changes hands. It could be a written communication, it could be a WhatsApp message, it could be a social media post, it could be the direct conversation that you have on the phone. This conversation, everything comes basically comes under communication. Now, what communication skills specifically do you need to have to be successful in this role? You need to be able to change your information, your presentation based on the audience that you have at the other end. So for example, if I am talking to an actuary in the insurance company, I am going to talk in the actuarial language. I am going to be very technical. I am going to talk about the actuarial concepts with that person. However, if now we are going from the actuary to the CEO in the insurance company, I have to make sure that I'm not talking about those technical concepts, but I give a summarized, clear message to the CEO on which he can make a decision and we can move on. So it is very, very important to distinguish between this information. If I am talking to a distributor in the Egyptian market, I am not going to talk about any QX or PX over there, because they have no clue what is QX and it's not relevant for them. So I have to make sure that the information that I am giving is changed to suit the audience that the information is being delivered to. This is the most important skill that a client manager needs to have. Second, interpersonal skills are very important. What are interpersonal skills? So basically, you will meet different type of people when you speak to them. So when I say different type of people, you will meet, let's say, 5 actuaries, but all those 5 people would be different type of people. They would have a different approach to life, different way to talk to them. So this is where interpersonal skills come in, to be able to speak effectively, deal effectively with different types of people. Then you need to have very good negotiation skills. Negotiation skills would be where you are about to enter into a contract, whether you are discussing entering into a contract, and you basically should have the ability to close out those discussions and close out deals. That is negotiation skills, and I will club it with the sales skills because these are basically the same. Moving on, talking about relationship management, I have explained this a lot in the previous slide, that there are so many stakeholders. So hence you already have an idea why relationship management is important. Next is ability to inspire trust. Now you are selling something to someone. Next year you will sell that same thing again or something more. So the other party needs to trust you, and you need to build that trust. When you trust someone, you go back to that company. So for example, let's say you're using Careem and Uber in Egypt. Now, if you have a bad experience with them, you'll think 2 times about using them again. But if you have a good experience, you will continue to use their services. You'll continue to go back. This is the ability to inspire trust, which is what a client manager should be able to do. Moving on, naturally, you should be good with numbers. And I believe all actuaries are usually good with numbers because that's what we do all the time. So I'm sure all of us would fit this, definitely. You need to be really good with deadlines. And why you need to be good? Because you'll have targets and you will have timeline to fill in those targets. So you need to be really, really good in meeting those deadlines. Next, results-driven approach to meet targets. Again, because now you will be given targets. Now it's you will have a target that you need to sell this much in this 12-month period. Now it's up to you what you do. So you need to have an approach which will lead to those targets. You can't come at the end of the year that I tried, but this did not happen. You have to make it happen. And that thing is called a results-driven approach. Next, naturally, since you're talking to so many people, you have interpersonal skills, so you will most likely be a social person. Because, you know, in my day, I meet, I don't know, maybe I meet 15, 20 people every day and of different subjects, and I have to speak different things to them. And that is my daily routine. So you have to be social, definitely. So let's move on to the next slide. Now, in this final slide, which I will quickly wrap up in the next 2-3 minutes, so we have some time for some questions. Basically, in a reinsurance company today, Chris and I have spoken about 2 roles that an actuary has in an insurance company. One is a pricing actuary's role, and the other is a business development and client relations role. But in this slide, there is a long list of tasks that the actuaries do in reinsurance companies. So if, let's say, we had more time, we can have one person from each of these departments come here, speak to you and tell you what they do in these departments. Now, some of these you would be familiar with, and some of these I'll quickly explain to you what those are. So valuation, it's typical valuation, what you do in insurance companies, what you read in the books. This is exactly that valuation. Setting aside reserves, calculating the appropriate reserves that need to be set aside. Experience monitoring is where, when you actually start writing business, experience starts coming in, you start monitoring it, you start finding out what are the bad things happening, identifying bad trends, and taking actions on them. So that is experience monitoring. Next, risk management. Again, I'm not going into details because everybody knows what risk management is. And then comes financially motivated reinsurance. Financially motivated reinsurance, it's a new, it's not a new thing, but it's something which is getting a lot of popularity. I encourage all of you to go and search about it after this presentation is over to understand in more detail what this is. So this is basically what Chris spoke about. Reinsurance was basically more about transferring your risk. But when you transfer your risk and you also have financial goals, so you transfer risk plus financial goals, you meet your financial goals with the help of reinsurance. It is called financially motivated reinsurance. So for example, you have some financial needs that you want to meet. So you can approach a reinsurance company, they create a structure for you, you transfer risk and also meet your financial goals. That is financially motivated reinsurance in summary, but definitely I encourage you to take note of this now. Go and search what this is after this is over. Next, property and casualty. Health insurance, treaty management. Treaty is an agreement between the insurance and the reinsurance company. Data analytics and artificial intelligence, a very up and coming new field. You are seeing this everywhere. So the actuaries in reinsurance companies are also employed in this department. Very, very interesting new field. Investment management, and finally, internal audit. So those are basically the wider, so all of these are basically roles that the actuaries can perform in reinsurance companies. So you see, there are so many departments, so many places and areas that you can work with in a reinsurance company such as Munich Re. So that's it from our side. And please feel free to ask any questions. You can put your questions in the chat and we will be happy to answer them.